Welcome to Rising. I'm back at the desk with Jessica Burbank, who I was just telling about all the fun things there are to do in D.C., including riding the e-scooters everywhere, which I like to do, but you have not yet tried.
Robby's a big scooter guy. I've just been running around.
Oh, they know, but you're learning.
Oh, yeah, it's new to me. I've just been running around, checking out the Federal Reserve building, which is under construction, so both fiscal and physical problems there, but that's the extent to my adventures.
Well, we're going to get into some financial news today, aren't we? We're also going to speak to Forward Party founder and former candidate for president Andrew Yang. You won't want to miss that. But first, the news I just teed up. Take it away, Jessica.
Burbank on the banks. Well, Robby, First Republic Bank failed yesterday, jeopardizing some $230 billion in assets. Regulators seized the bank and sold it to JPMorgan Chase, the nation's largest bank, in a deal that will wipe out shareholders but protect deposits. First Republic relied heavily on wealthy clients, with more than 2/3 of its deposits surpassing the FDIC's $250,000 insurance limit. This is the second largest bank collapse in U.S. history, falling only behind Washington Mutual's failure in 2008. The U.S. government also brokered that bank sale to JPMorgan Chase. In fact, 3 of the 4 largest bank failures in U.S. history have taken place over the last 2 months, sparking concerns about the strength of the country's banking system. Bank executives, however, are downplaying the worries. JPMorgan head Jamie Dimon, according to The Guardian, he said on a conference call that, quote, this part of the crisis is over and that conditions are, quote, nothing like 2008 and 2009.
Critics blasted the FDIC for authorizing a deal that effectively allowed JPMorgan Chase to purchase a major bank's assets at a government-subsidized discount for a massive profit. President Biden assured Americans yesterday that their tax dollars are not going to bail out First Republic.
Regulators have taken action to facilitate the sale of First Republic Bank and ensure that all depositors are protected and the taxpayers are not on the hook. These actions are going to make sure that the banking system is safe and sound, and that includes protecting small businesses across the country who need to make payroll for workers and their small businesses. And so let me be very clear. While depositors are being protected, shareholders are losing their investments. And critically, taxpayers are not the ones that are on the hook.
So what are we to make of this trend of, too big to fail, it gets even bigger when the failing banks get gobbled up by JPMorgan Chase?
Well, I think it's a problem that we say, okay, JPMorgan, you get to now have all of these customers. Congratulations, because we don't want, as regulators, for us to be the ones responsible and have to tell the American people, we're going to back this bank up. Of course, the FDIC has said if more banks fail, given the current financial climate, we will back up beyond the $250,000 in insurance that we typically do. However, what's going to happen is they'll then seize the bank's assets and liquidate them to regain that money, to get that money back. So for it to not be a burden on the taxpayer is very good. Is JPMorgan Chase growing its customer base this quickly, just essentially saying, okay, First Republic, like all of your customers are mine now? We talk about the difference between taxpayers and the American people as if they're not the same thing, but First Republic's customers are the American people. Is it fair that the government can just say, now you bank with JPMorgan? That's an interesting facet to this. I think it's good and just that they're backing up the depositors and not the shareholders.
Right. We want people, I said this when Silicon Valley Bank collapsed, that look, if you want to gamble, if you want to go to the casino, that's fine by me. Libertarian over here, you can do whatever you want, and if you lose, you lose. But it shouldn't be, if you win, you win, but if you lose, someone else pays for it, which seems to be how so much of the banking system works.
It's concerning to me in the respect that, okay, you had these banks that were kind of small. After the 2008 crisis, we had the Dodd-Frank regulations where they said banks have to stress test. Then you had a bunch of banks lobby that were small banks, and they said, you know what, we actually think we should push that limit to $250 billion in deposits. This bank failed at $230 billion. Mm-hmm. So by moving this benchmark for when banks were required to stress test, does this have an impact? It seems that banks, out of the goodness of their heart, will not say, we're not going to do risky investments. We're going to try and make as much money as possible. And if we fail, we fail. They seem to be quite okay with that. Given that they can be bailed out, is there a moral hazard there? I'm not sure.
Right. That's because ostensibly, unless they're all just like gambling maniacs, and maybe a couple are, but it would seem wild for people. Again, if they're going to suffer the consequence to experiment insanely with their money, and it doesn't work out, and they pay for it, and like that should that's an incentive. But if they get bailed out and they get bought up and there's not really any consequence, there is a consequence here because the shareholders are getting wiped out. What's the shareholder thinking when they're investing in this kind of project? They're saying, oh well, I'm taking a risk, I guess, is what they're thinking.
That's what I would assume, right? Because, as you would say, Robby, as a libertarian, they have all the information they would need to make the decision about where they should invest their money. It's interesting that these folks who are bankers, who are supposed to very thoroughly investigate the risk of what they're doing and where their assets are, and can they back up all of their deposits, these are all considerations. And there's been some folks saying that a lot of the banking collapses we'll see. Right, JPMorgan Chase said it's pretty much over. This is the last one. This part of the crisis is over. They're saying a lot of these banks made some risky investments with very wealthy folks. A lot of them concentrated to tech. A lot of them concentrated to Silicon Valley. Right. To me, that sounds like crypto. We know that Coinbase and a lot of these platforms where you can purchase crypto, they had branches where they encouraged banks to keep a proportion of their assets in cryptocurrency. We're not hearing a lot about which of their assets fell through, where these losses are coming from. I don't attribute all of it to risky investments in zero coupon bonds. I think there's something else going on here that they're not telling us.
You're talking about the volatility in the crypto market over the last, I don't know what period of time, the last few years.
Right. I don't attribute all of the losses to just we made some risky investments in the bond market and interest rates are high, and that's our main problem here. I think they were possibly holding more assets than they've allowed the American public to know about and their customers to know about in cryptocurrency.
What are your thoughts about cryptocurrency? You seem negative on the concept.
Yeah, I think people were sold a dream who are just like regular people. They were like, oh, like you invest some money in this, you get in early, you can make so much more money. And it's people who wouldn't normally be investing. They need to save that money in case of an emergency. And so it's hurt a lot of regular, everyday people who have put a proportion of money that should be in savings into this extremely volatile investment and who has gotten wealthy off of it. It's people like Elon Musk, who used his platform on Twitter to say everybody buy Dogecoin and inflated the price of Dogecoin with his public presence while he had millions invested in it. Like, that's the story of crypto. People who are very wealthy have been able to manipulate the market and make a bunch of money off of it, where everyday people have not.
But they can't make you put your money in it. It still was people making that decision. Like if you got tricked because you saw a commercial with, I don't know, was Matt Damon was selling it at one point. All these people saying, oh yeah, get your money in this. And you're like, oh, that's a great idea. I mean, isn't that on you?
The clutches of advertising on the American people. Yeah, I mean, it's complicated because there's this element of like false advertising that crypto was to be used as a means of exchange to compete with the dollar or something. Mm-hmm. It's never been a means of exchange. And people kind of thought, okay, I don't trust how the US government has run fiscal policy or monetary policy for quite some time. We need an alternative. And then to think crypto is that alternative, it's just not. Crypto gets all of its value.
Well, it's not right now, but if the elites crashed our financial system or something, right, that would be the idea. You could have an asset that was more. I mean, I definitely understand it for other parts of the world that are less developed, where there's corruption and greater instability in their financial system relative to crypto. We don't have that in the U.S. Crypto is less stable relative to the dollar, but I would understand it in Africa, South America, et cetera.
Well, crypto, I would argue, gets all of its value from people investing fiat currencies run by governments into cryptocurrency. That's how these coins get more value. It's more people buying them. In that respect, it's essentially an investment not dissimilar from other securities, right? It's not a currency. It's something that you can invest in, and the more actual fiat currencies that go into it, whether it's dollars, whether it's euros, whatever, that is what gives it value. That is what increases, the value of your Bitcoin. And when we tried to have these stable coins. As soon as they lose their one-to-one backing with the dollar, because people really value being able to exchange them for dollars, that is what gives crypto its value, that caused the whole market to collapse last spring. And so unless we have similar banking regulations for things like crypto, it will never serve that function of a means of exchange. And who's going to do those regulations, Robby? Clearly not the crypto guys.
Maybe not anyone. Well, not anyone right now, but they are talking.
As you would prefer it.
They are talking. The interesting thing was, right, they were, Sam Bankman-Fried was talking to some members of Congress, some Democrats, about a package of regulations that I gather would be very favorable to his specific crypto investments. So that's something to worry about. That I'm sure regulations are eventually coming, but who is going to structure them, and will they be beneficial to one specific player?
Yeah, that's a concern. I mean, there has been legislation introduced, and the Cassandras of crypto have been wildly unheard. But Rowan Gray, a few years back, introduced by way of Rashida Tlaib's office the Stablecoin Act 2 years before we had the whole stablecoin blow up just a year ago. That was largely overlooked by members of Congress. It was like screaming into the void when you were talking about the need to regulate things like a stablecoin. And now finally the Fed is fighting back, and we're seeing some folks clawing back some power of, okay, maybe we do need to more carefully regulate what this thing crypto is and how it's used, and have some kind of digital currency, which is making people very afraid. But when you have a digital currency that is well regulated, people like the convenience of crypto. People like the convenience of banking and being able to do things on your phone. Having that kind of fintech is something that the US government should be investing in. But people get afraid when it's one central actor, running it, which is why I think we need more members of Congress paying attention to it and making sure it's done properly.
All right, I'll tell you what's on my radar coming up next. Stay with us.